Good morning, everyone. We are expecting a few more people, but given we're now at 8:33, I think we'll start the webinar and hopefully everyone will just join us as and when they're ready. So good morning, everyone, and welcome to this VAT update, which Rycroft Glenton are presenting in conjunction with Bevan VAT Consultancy. Our presenters today will be Hilary Bevan from Bevan VAT Consultancy and Michael Parry, who is a director at Rycroft Glenton. Hilary has over 20 years experience in accountancy and VAT and provides specialist VAT advice to businesses to help them wrestle with the complexities of VAT. So as you can imagine, she's kept very, very busy. Michael trained at RG and has now been with us for over 14 years, advising clients in a wide range of business sectors on accounting and taxation matters. This webinar will start with a VAT refresher, followed by VAT announcements and news from HMRC, and we'll finish with a case update. Our presenters are very happy to take questions as we go along. So if you want to ask anything, you can either raise your hand, or if you prefer, you can use the chat box. There will also be an opportunity to ask questions at the end of the webinar. So if you don't want to ask as we go along, there will be time for you to ask any questions that you might have. So welcome everybody, and I'll now hand you over to Hilary.
Excellent. Thank you very much, Deborah, and good morning, everybody. Thank you very much for logging on this early to learn about VAT. Obviously, for me, that's an ideal start for the day, VAT bright and early, but I appreciate that for everybody else, it might not be your favourite topic. So thanks very much, everybody, for coming. And as Deborah said, there we go, the slides are working. We're going to go through a bit of a VAT refresher and a little overview of partial exemption, because that seems to be something that comes up a lot. Some VAT announcements and news from HMRC, and a little case update on some interesting cases that have caught my eye recently. And we are going to rattle through everything relatively quickly, because that is quite a lot to fit into one short webinar. So as Deborah said, if there's anything that you'd like me to go back to, I'll go over in more detail. If you've got any questions, do just let us know and we'll try and answer those. Even if we can't answer them this morning, we'll be able to get back to you with an answer later if it's not something we can do quickly. So we'll start off with VAT refresher and partial exemption overview. So hopefully some of this will all be familiar to you, but maybe there will be a few bits that you're not sure about, and it'll help you get it straight in your head. And the reason I thought I would cover partial exemption, it seems to be an area where lots and lots of questions come up. And even at the VAT Practitioners Group conference in June, we had some representatives from HMRC there, and they were talking to a room full of VAT specialists, asking us how VAT could be simplified. And the number one complication for everybody was partial exemption. If we could get rid of exemption, that it would be a lot easier. But then I suppose I'd be out of a job, so perhaps I don't want to get rid of it completely. But just thought it is an area where lots of people aren't 100% sure on the rules. So definitely worth going through, worth refreshing you. So as a start, just in general for VAT, VAT's payable if a taxable person makes a taxable supply in the UK or Isle of Man in the course of business. And we're going to drill down into what some of those headings mean just a bit more. So taxable person is a person carrying on a business who is registered or required to be registered for VAT. So that's either someone who has a voluntary VAT registration or someone who's had to register compulsory because they've gone over the turnover threshold. And when we say person, we don't actually just mean what you would think of as a person. We don't mean a human. So a taxable person, it could be a sole trader, could be a partnership, limited company, trust, and pension schemes, all sorts of things like that. So we don't, although we use the terminology person, it's not actually a human person. A taxable supply is goods or services provided in exchange for consideration. So the most obvious example that we think of, if I go in a shop and I buy a Mars bar and hand over my money, there is a supply and there is consideration. Not always as easy as that to identify. Sometimes if you've got barter transactions and grants and things like that, but the principle is you are giving somebody something, some goods or services, in exchange for consideration. And it's only taxable if it's liable to a positive rate of VAT. And we're going to come on shortly as to what sort of things fall under the different VAT rates. So the types of supply that we have pretty much split into these two separate rows. So standard rated supply is a supply that's subject to VAT at 20%, but you can recover all of that VAT you incur on costs in making that supply. A reduced rated supply is currently 5%, but you may remember during COVID for a short while, we had an alternative reduced rate of 12.5% on some hospitality stuff. So reduced rate is 5% VAT. Again, you can get all of your VAT back on the costs you incur. Zero rated, VAT is technically due, but at 0%, but you can get the VAT back on all of your costs. And that's the key thing about that top line on that slide. You can recover all of the VAT you incur on the costs in making a supply that is standard rated, reduced rated, or zero rated. When we come on to the next line, the bottom row of this slide, it's not quite so straightforward. So where a supply is exempt, and people often confuse zero rating and exemption. So where it's exempt, you're not charging VAT on the supply you make, but equally, you cannot get the VAT back on the costs you incur in making that supply, unless they're within de minimis limits, which we're going to come on to later. And then, just because VAT is never straightforward, we have two different types of supply, and they're both called outside the scope of VAT, just to make things confusing. So something is outside the scope of UK VAT if it's potentially VATable in another country. So, for example, if you are supplying consultancy services to a company in Spain, the place of supply will be Spain, and it's outside the scope of UK VAT. But you can usually get the VAT back on that supply. And the rule there is, if it would be VATable if you did it in the UK, you can get back the VAT on the costs. If it would be exempt if you did it in the UK, you can't get the VAT back on the costs. So sometimes you can get the VAT back. The other type of outside the scope supply is non-business. So that's where you are not making a supply in exchange for consideration. So I suppose an example recently would be all the coronavirus job retention grants that people got. You're not doing anything, you're not providing anything to the government in exchange for that money. So that's non-business income. Generally, you can't get the VAT back that you incur in costs in making non-business supplies. There are a few exceptions to that. So things like hospices, academies, search and rescue charities, those sort of things can get the VAT back on non-business costs. But generally, if you're generating non-business income, carrying out non-business activities, you can't get back the VAT on the related costs. So hopefully that helps you get it straight in your head. Basically, everything you do, every piece of income you generate, every activity you carry out will fall within one of those boxes. And therefore, that gives you your VAT treatment. I'm just going to have a little sip of water before we go on to the next slide. So, talk about what the different boxes are. I thought it might be useful to talk about what sort of things fall into those boxes. So, outside the scope, I suppose the key one, I mentioned the job support scheme, all the COVID grants, but any grants are the same. So if you receive a grant from, for example, the National Lottery gives out grants for projects that they think are worthwhile. The government quite often provides grants for things. So if it's a genuine grant, you're not providing a service in exchange for money, that's outside the scope of VAT. Anything which has to be paid, so things like fines, MOTs, your road tax for the car, where they're required under statute, again, It's not a supply in exchange for consideration, so it's outside the scope of VAT. And for charities, another big one is donations. The thing with donations is you have to make sure it is actually a donation. If you say you can come to our event if you give us a £10 donation, that's not a donation, it's a payment to go to the event. Whereas a genuine donation, that's outside the scope of VAT. When we come on to the others, the key thing, I don't know if you can see me on the screen, but this big book of VAT legislation actually includes a schedule of things which are exempt, things which are zero rated, and things which are reduced rated, and gets updated every year. And obviously there are lots of caveats and lots of conditions for every single one of these headings, but the main things that are exempt from VAT, you've got land and buildings. So if I buy a house and then a few years later I sell that house, it's exempt from VAT. If I buy a piece of land and sell it, it's exempt from VAT. So there are exceptions to that. If it's a commercial building under 3 years old, it's VATable. If it's a new dwelling, it's zero rated. If the seller has made an option to tax, 20% VAT, but the default position, land and buildings, exempt from VAT. Some of the things you can see on that list, they are exempt from VAT, but that's actually because they're taxed in a different way. So insurance that you can see on there, insurance is exempt from VAT, but it's subject to insurance premium tax. And betting and gaming, again, there's gambling duties, there's games machine duty. So it's taxed in different ways, which is why it's treated differently. Finance is a biggie. Again, you've got to look at the detail of it and see what's happening. But things like bank charges that you're charged on your bank account will be exempt from VAT. Education, it depends who's providing it. Generally, provision of education by an eligible body, such as a school or an academy, is exempt from VAT. Health and welfare, again, lots of conditions, lots of caveats, but generally doctors' services will be exempt from VAT. Burial and cremation, we actually come onto a case later to do with burial and cremation, but disposing of the remains of the dead is exempt from VAT. Some subscriptions are, and sports, but again, there's lots of caveats. You've got to meet some eligible body rules. It's got to be for an individual taking part in the sport. So it might be things like subscriptions to a golf club or something like that fall within that exemption. But they're all listed in the legislation, and they're all very, very specific things. Because this is a relief essentially from VAT, it's always interpreted quite narrowly. So you've got to make sure you meet those criteria for your supply to be exempt. And then we come on to zero rating, and the number one that most of you will be familiar with is food. So if you're going to the supermarket, you're buying a loaf of bread, vegetables, meat, all of that will be zero rated. So there's no VAT, but the person providing the food to you can recover the VAT on their costs. Again, there are some exemptions. I'm sure most of you will be familiar with the Jaffa Cakes case, which is the most famous food one, and whether a Jaffa Cake was a cake or a biscuit. There's always lots of interesting cases on food. In fact, we've got a couple that we're going to cover later. Sewerage services and water. So your domestic water bill that you get at home, there won't be any VAT on that. Books, there's no VAT on books, newspapers, things like that. Construction of dwellings, so I'd referred to that on the previous slide. We saw generally land and buildings is exempt. Where you're constructing a new house for somebody, that's zero rated. So the idea is that it encourages people to build new houses. It's favourable VAT treatment. You want to get more houses out there for people to live in. Probably not worth me going through all the others in humongous detail. I suppose I'll just pick out there. So sale of donated goods, that's things like a charity shop, and they don't have to pay VAT on the goods that are donated to them that they then sell in the shop. And children's clothing is zero rated. Once it gets over a certain size, it's 20% VAT. I mean, they got reduced rating, not as many things. These tend to be the political things are added to reduced rating. So domestic fuel or power, your electric bill at home, your gas bill at home, you'll only be paying VAT at 5%. And actually it's 5% if you're within certain de minimis limits. So smaller businesses may well be only paying 5% instead of 20% as well. Residential conversions. So if you buy an office block and you're converting it into flats, the work there would be subject to VAT at 5%. Again, it's probably not worth me drilling into all those in detail, but if there's any of those on that list that you do provide, you should be, provided you meet all the criteria, should be charging VAT at 5%. And then standard rating, which is the biggest, the main one, 20% VAT. There is not a list in the legislation of what is standard rated. Basically, that is the default position. You look in the list of exemptions, look at the list of zero ratings, look at the list of items subject to VAT at 5%. If it doesn't fall within one of those, it is standard rated. So if in doubt, 20% VAT. So I'll just have another little sip of water before we move on to partial exemption. So partial exemption, I think, catches some people out because they perhaps either don't realise it applies to them, or even if they do realise it applies to them, don't fully understand the logic behind it. And I don't want to make it sound too easy, because obviously we're covering it quite quickly here, and I do actually present a full day course on partial exemption, so we are necessarily only skimming over it. But I think fundamentally, if you can get your head around the principle, actually dealing with the calculations becomes a lot easier. So if you think back to that earlier slide about the different types of supply you might make, if you are making supplies which are 20%, 5% or zero rated, you can get back all of the VAT you incur on the costs to make them. If you are making exempt supplies, you can't get back the VAT on your costs. And that's the basic fundamental principle you need to understand. So if you have a company which just manufactures tables, all of your sales of tables are subject to VAT at 20%, you can get back the VAT on all of your costs. Easy peasy, relatively. And if you have a company which just provides exempt insurance, all of your income is exempt, therefore you can't get the VAT back on your costs. Easy peasy. But what if you have a company that does a mixture of things? What if you have a shop, so fully VATable shop premises, but they have a flat above the shop and residential rental income is exempt? So you buy a Mars bar to sell in the shop, you can get the VAT back on the costs. If you pay to redecorate the flat in between tenants, that relates to exempt income, so you can't get the VAT back. Partial exemption, when we're talking about partial exemption, it's thinking about the things that fall between those two extremes. Because what if you pay to have a new roof put on the building? That roof actually benefits the shop business and it benefits the exempt flat above it. What about if you pay an electric bill for the whole building? That benefits the exempt part and the VATable part. So when we're talking about partial exemption, that's what we mean. It's working out how much of that VAT you can recover. And there's 3 steps essentially to working out how much VAT you can recover. And the first step is to allocate the invoice when it comes in. So every purchase invoice that comes in, does it relate wholly to one type of income? Have I bought a new till for the shop? Have I bought some shelving? Have I bought some stock to sell in the shop? If that's the case, if it relates fully to your VATable income, you get all of the VAT back. Does it relate just to the exempt bit? So in the example I gave, is it that you have a separate electric bill for the flat above and you've just paid the electric bill for the flat? Or is it that you have bought some new crockery for the kitchen, or you have paid to have the gas safe test done and things like that? So those things that come in, when the invoice comes in, you need to think, does it relate to non-business income? In which case it's not recoverable unless you're hospice, academy, etc. Does it relate just to exempt income? In which case it's not recoverable unless it's within the de minimis limits that we're going to come on to. Does it relate to VATable income? If it relates to VATable income, we get it all back. Or is it a mixture? Is it an electric bill for the building as a whole? Is it putting a new roof on the building? Is it your accountancy bill that you've got that relates to both parts of the business? Where it does relate to a mixture, we call that residual VAT. And that means it doesn't relate just to one type of income. It relates to the business as a whole, your VATable income and your exempt income. Some people call it overhead VAT. Some people call it non-attributable VAT because it's not attributable to one specific type of income. Some people refer to it as the pot. I think it depends who trained you, and what they called it is usually what you end up calling it. But all of those things mean the same, essentially. It's this bit of VAT that relates partly to your VATable activities and partly to your exempt activities, and therefore should be partly recoverable. So once we've done that, that's our first step. Every invoice that's come in, we've divided it into 3 columns. It's fully recoverable, it's not recoverable, it's partly recoverable. So then we move on to step 2, which is our apportionment. And what we're doing with our apportionment is working out how much of that residual VAT is recoverable. And some people, if you've got some non-business income as well, you have to split it between business and non-business before you split it between exempt and taxable. For the split between business and non-business, you're allowed to use any method which gives you a fair and reasonable result. So lots of people might do it on a proportion of income. Sometimes they might do it on floor space. If it's just somebody's given you a £20 donation and you've not actually had to do anything to get that donation, you might not allocate any costs to it because it's not used up any of your resources to generate that income. When we come on to the split between exempt and taxable, there actually is a prescribed method that you have to use, and it will either be the standard method or the special method. So the standard method is what you've got to use if you haven't agreed anything else with HMRC, and it's taxable turnover divided by your total business income to give you a percentage. So if 60% of your income is VATable, 60% of the VAT on your residual costs is recoverable. And you always round that up to the nearest whole percentage. You exclude sales of assets and things like that because obviously that distorts the figures. But the advantages of that are you don't have to get in touch with HMRC. You just do it. It's the default position. And the figures are generally readily available. You'll be able to extract from your accounting software how much of your income is VATable, how much your total income is, work out that percentage. So it's relatively easy. And it kind of feels logical. The more, if 80% of your income is VATable, you get back 80% of the income on your costs. If only 10% is VATable, you only get back 10% of the income on your costs. So it's logical. But it doesn't always work. Sometimes that falls down. So if that doesn't give a fair and reasonable result, you can apply to HMRC to use a partial exemption special method, a PESM. So, for example, I had one once where it was a golf club client, and golf clubs, for those who aren't familiar, have a lot of exempt income, which is the golf club subscriptions, and a lot of VATable income, which is the bar and catering. And this golf club built a new clubhouse, and about 90% of that clubhouse was used for bar and catering, so generating VATable income, and about 10% of it at the side was a small changing room for people who were going out and playing golf. So if we'd used the normal method, the standard method, they probably would have only got about 40% of the VAT back on that building, because only 40% of their overall income was VATable. But when you looked at the floor space of what that building was being used for, 90% of that floor space was generating VATable income. So the standard method didn't give a fair and reasonable result. So you apply to HMRC and give them an alternative method. And as long as you can explain why the standard method isn't fair and reasonable and why something else is, that they will generally agree that. But you do have to have it agreed with HMRC in writing. You can't just decide to do it for yourself. Might be based on floor space. Sometimes it's on head count. If you've got 2 members of staff who work on the exempt side of your business and 8 of them work on the VATable side of your business, you might do 8/10 is recoverable. Sometimes it's based on number of transactions. If it takes you the same energy, the same resources to make a £1 million sale as it does to make a £100 sale, maybe you do it on a number of transactions. But it's where the standard method doesn't give a fair and reasonable result, you'd apply for a special method. And then our third step, so we've worked out how much VAT is recoverable, and quarter by quarter, we've either got back VAT from HMRC or paid VAT to HMRC, depending which way around it is. At the end of every VAT year, we then revisit that. And your VAT year is not necessarily the same as your accounting year, your financial year. Your VAT year will always end in March, April or May, unless you've agreed something else with HMRC. And when we get to the end of the year, you're reworking the calculation. So exactly the same calculation, but you're doing it for the year as a whole rather than quarter by quarter. You compare it to the quarterly figures, and then you either owe it some money to HMRC or claim some back. Sometimes it's a bit frustrating because you'll spend 3 hours doing the calculation and it'll end up that there's £12.50 that's owed or something like that. But you do have to do that every year, and you include that adjustment on your last return of the year or the first return of the next year. And de minimis, I touched on the de minimis limits before. The irrecoverable VAT, so the irrecoverable VAT is any costs which are directly attributable to exempt income and the irrecoverable percentage of that residual VAT. If that's under 7.5 grand and under 50% of the total VAT on costs, you can recover all of it. And quite usefully, if you're de minimis 1 year, you can assume you are de minimis for the next year and just do the calculation at the end of the year instead of doing it quarter by quarter. So that can be useful if, for example, say you're a farm and you've just got most of your income is VATable farm income, sale of crops, sale of livestock, and you've got 1 residential property there that you rent out. So you've only got a very small element of exempt income. Sometimes that de minimis rule is useful, that you can just check it once a year. So that brings me to the end of the refresher and the partial exemption bit. We're now going to have a little look at HMRC systems and updates. So these are just a few things that have been released over the last few months that I thought might be of interest to people. There is one actually which is not on my slides because it was announced after I prepared the slides. From the 13th of November, apparently you're not going to be able to submit a VAT registration application by paper anymore. You have to do it online. I'm not entirely convinced that's going to work because you can't submit it online if you don't have a UTR, unique taxpayer reference. If you're a brand new company and you need to register straight away, you won't have received your UTR. But I believe you are supposed to be able to get in touch with HMRC and ask for a paper copy if you need one. But the idea is it's digital by default, so that they're trying to direct people to online first. But yeah, that's not on my slides because that is relatively recent announcement. Online payment plans. Some of you may have heard of a time to pay facility. That's where if you owe HMRC an amount of tax and you haven't got the funding to pay it immediately, they will sometimes agree that you can pay it a bit at a time. Now, where it's less than £20,000 and these conditions are met, you can actually arrange that with HMRC online rather than having to ring them up. So your VAT returns have to be up to date. got to owe less than 20 grand. You've got to apply within 28 days of when it was due, and it won't work. If you've already got a time to pay agreement in place, you'll actually have to ring up and speak to someone. And the idea is it's got to be repaid within 6 months. So you might suggest we'll pay you £4,000 a month for the next 4 months, depending how much is due. But it should make things slightly easier. And now I'm going to hand over to Michael, who is going to give you a little bit of an update on the new penalty regime, which has come in from the beginning of this year.
Thanks, Hilary. Morning, everyone. So yeah, I'm going to talk through the new penalty regime, which replaces the default surcharge for VAT. I suppose it's designed to make the penalties slightly more proportionate than the old scheme, where the penalties were fairly harsh, especially when you compare them to the penalties under other tax regimes such as corporation tax. So the new penalty regime applies to VAT return periods starting on or after 1st of January 2023. So people filing monthly or quarterly VAT returns, this is in effect now. If you're filing an annual return, then it won't have come into effect just yet. And the new penalty regime, we've got now a separate treatment for late payments and late filing of returns. They're treated separately. So we'll cover that off as we go through. So the new penalty regime for late submission, you now receive 1 penalty point every time a return is late. So it's a £200 penalty if you reach your points threshold, and then £200 for each subsequent late return. And the threshold depends on how frequently you submit VAT returns. So if you're on the annual VAT scheme, then you only need to file 2 late before you receive the penalty. Quarterly returns, it's 4 points, so that's a 12-month period. If you file 4 times late in a row, you get the penalty of £200. And monthly, excuse me, it's 5 points, so 5 monthly returns. So the points can be removed if the returns are submitted on time for a set period, and all of your returns due in the last 24 months are now submitted. Now, to do that, you need to start what's deemed a period of compliance, and the period that you need to comply with is again linked to how frequently you submit your VAT return. So annual returns, it's a 24-month compliance period. Quarterly returns, it's 12 months, and it's 6-month compliance period for monthly returns. If you don't hit your threshold, then the individual points just expire after 24 months automatically. And one of the key changes now really is that this applies to nil returns and repayment returns as well as payment returns. So previously, if you were in a repayment position or submitting a late return, wasn't really a penalty for submitting late. There would be a penalty for late payment, but obviously, well, that was previously linked as a percentage of the liability due. Obviously, if you're in a repayment position, there was nothing due to HMRC, so you wouldn't actually suffer any penalty at all. You'd get a letter through the post saying that you'd filed late. That was probably about as bad as you could expect, really. So those of you filing nil returns or in repayment positions frequently, it's a slight change there. You just got to keep on top of the compliance. Now onto the new penalty regime for the late payment side of things. So this is designed, as I mentioned, just to be more proportionate with the sort of offence committed. So previously, under the default surcharge, a late payment penalty would apply even if you were just a day late, and the range of penalties was anything from 2% to 15% of the VAT due, depending on how often you've been late paying in the past. So now you've got a slight grace period, so there's no penalty due if you pay within 15 days of the due date, or if you agree a time to pay arrangement in that time period. There will be interest due, which we'll touch on slightly in a second. If you pay 16 to 30 days late, the penalty is 2% of the VAT due. And then obviously the longer you take to pay, the penalty scales up. So 31 or more days late, the penalty is 2% of the amount outstanding at day 15, plus a further 2% of the amount outstanding at day 30, plus then 4% per year until the balance is paid in full. HMRC currently charging interest at Bank of England base rate plus 2.5%, so that's currently 7.75% with the interest increases recently. So it's getting more expensive not paying HMRC. Have introduced interest on late repayments from them, so they now pay interest at Bank of England base minus 1%. And a few of my clients have actually benefited from that already, where HMRC have performed checks on repayment VAT returns, and a little bit of a benefit there for them in while they have to wait for the money to come back, at least they got something for it now, when previously HMRC didn't pay you anything. So quite a few changes there to go through on the late on the penalty regime, but just some things to be aware of. Obviously, if you're all filing on time and paying on time, nothing to worry about. And I'll now hand back to Hilary.
Excellent. Thank you very much, Michael. Yeah, I think that's the key point you made at the end there. If everybody's filing on time, none of this will be a problem. So yes, it's to be aware of, but hopefully if you get stuff in on time, it shouldn't be an issue. So a couple more updates that have come out from HMRC. One was on apportionment in mixed supplies. So this is the sort of thing where you're supplying something which is perhaps zero rated and something which is standard rated together. So maybe if you've got a hamper with different foods in, and some of those foods are standard rated, some of them are zero rated, and they were looking at whether there should be any changes in the rules. They did a consultation in 2021 and actually concluded, no, we don't need to change the rules. What we need to do is just actually provide some guidance so that people understand what the rules are. And basically, you can work it out based on selling price. So if 50% of your selling price is VATable, treat 50% of your income as VATable, or based on cost. If 50% of the cost is VATable, treat 50% of the income as VATable. And it might be selling price. You might have, if all of the individual items in the hamper or in the package do have their own selling price if they're sold separately. Sometimes you might not, because some of them may only be available as a package. They might not have their own individual selling price. But what I would suggest, if you do anything like that, is have a look at those links that I've put in there, because actually HMRC have given worked examples with figures on both of those methods, and they're actually pretty useful and easy to follow. You don't have to use one of those methods. You can use anything that gives a fair and reasonable result. But I think, to my mind, if HMRC have suggested them, why would you not use them? I'm struggling to think of any circumstances where one or other of those methods would not give you a fair or reasonable result. And at least if you use one of those, HMRC are unlikely to challenge it, because it's their logic, it's their guidance. So definitely, if you do anything like that, if you make hampers, perhaps now we're coming up to Christmas, have a look at that guidance as to how you should be dealing with it. And we've got energy saving materials. So this hasn't just happened in England. It actually, the new rules came in from the 1st of April 22, but Northern Ireland was added from the 1st of May this year. And the principle is energy saving materials. So that's things like your ground source heat pumps, your solar panels, your wind turbines, are zero rated if they're installed in residential accommodation. So if you buy some goods on their own, that wouldn't qualify. If you went out and bought some solar panels and you're going to fit them yourself, that would be subject to VAT at 20%. But if you pay somebody to install them on your house, that would be zero rated. This is, in theory, only temporary. It's going back to 5% in 2027. But I do wonder how that'll go down. I can just imagine the press saying evil chancellor wants to charge VAT on energy saving materials. So I don't know, when we get to 2027, maybe they will extend the zero rating. I've put a link there to the guidance. So if you are doing anything like that, you can have a look to see if it fits. But I think just be careful if there's a supply that just includes an element of energy saving materials, because if you already have a roof and you go in and you insulate it with energy saving qualifying insulation, that will be an installation of energy saving materials, zero rated. If instead you are replacing an entire roof and happening to insulate it at the same time, you're providing an insulated roof, not energy saving materials. So it's just a key one. If there's something like that, just be careful that what you're providing does, or receiving, does qualify for the zero rating, because it doesn't always. And the last update, so although this section generally has been on recent announcements from HMRC, this one's actually from 2008, but I think it's very, very relevant at the current time. So I wanted to just touch on it. So if you think back to when we talked earlier about partial exemption, if you're building something and it's going to be zero rated, you can get back all of the VAT on the costs. If you're going to be making an exempt supply, you can't get the VAT back on the costs. So with a new house, if you build a new house to sell it, zero rated, get all the VAT back on the costs. If you're building a house to rent it out, that's exempt, so you can't get the VAT back on the costs. But the difficulty we've got when there are financial crises happening is that people may have built a house with the intention to sell it and actually find at the time that they can't sell it. So 2008, it was the financial crisis and all the mortgage crash and everything. At the moment, obviously we've got interest rate, well, they seem to have leveled out now, but interest rates are going up and up and up. So lots of people who may have previously planned to buy a house may not be able to get a mortgage now because of those interest rates. So house builder may have just planned to sell the house, but have to rent it out for a bit until they can sell it. And HMRC has suggested do a calculation for your partial exemption, estimated eventual sale value, so that's your taxable income, divided by your estimated sales value plus estimated short-term rent. And this link doesn't actually work if you click on it, so I apologise, it's a very, very long link, but it's because the HMRC guidance has been archived, but it is actually available online, so you can find it there if you need it. But definitely useful if you've had to change your plans because of the financial crisis. So move on to case update. I think I've only got about 4, so hopefully this won't take too long, and then we can see if there's any questions at the end. So Sonder Europe, and maybe won't talk about this as long as I was going to because it's actually been appealed. So the answer we have now is not necessarily the final answer. But generally, if you supply serviced accommodation, rented apartments, short-term accommodation like that is standard rated, and you would have to declare VAT on all of the income. There is a tour operator's margin scheme which applies where you are making an onward supply of accommodation, transport, things like that. Under the tour operator's margin scheme, you only declare VAT on your profit margin, not on the entire income. So significant difference there. This company leased apartments and they let them to travellers short term. HMRC said, it's not Tom's, what are you talking about? Doesn't fall within those rules. We want VAT on the full income. And they went to court, went to the first tier tribunal, and the first tier tribunal actually agreed with the taxpayer and said, actually, VAT is only due on the margin. So a lot less VAT than HMRC thought was due. I was going to say, if you have any businesses which do property letting like this, by renting apartments and let them out, you might be able to put in a claim. It's been appealed, so I think at the moment, wait and see. It might be worth looking at putting a claim in to HMRC because you can only go back 4 years, but it's not certain that will be successful. UK funerals online. So this was an interesting one. I mentioned when we were talking about exemptions that we'd come onto this. So UK funerals online, they provided repatriation services. So where somebody died in one country and their body needed to be taken to another country for their funeral, that's the service they provided. And they said, this is zero rated cross-border transportation of goods. I think there was some people, obviously goods is not a very nice way of describing somebody's deceased relative, but actually they were able to prove that on the flight manifest, it's actually described as cargo rather than a passenger. HMRC said this is exempt because it's a service in connection with the disposal of the remains of the dead. And the key thing, if you remember from the refresher we did at the beginning, if it's 0 rated, you can get the VAT back on all of your costs. If it's exempt, you can't get the VAT back on any of your costs. So big difference to the taxpayer. And the taxpayer in this case pointed out that they'd actually had several VAT visits, and at every VAT visit, HMRC had agreed with them it was 0 rated and had only now changed their mind. But the courts actually said it's both. Either one can apply. And the interesting point from that case is actually where something does fall in 2 different categories, 0 rating takes precedence over exemption. So even though it falls within both, they can treat it as 0 rated. But it was an interesting one. It was things like the coffin had to be lined with zinc because of the transportation rules. And if you were just burying someone in the UK, you wouldn't zinc line the coffin. The embalming process was different. It used different chemicals. But then HMRC pointed out the coffins you could choose ranged from £500 to £20,000. And if all this was transport, why on earth would you pay £20,000 for something you could have for 500? So you can kind of see both arguments there and why it fell within both. So I think that's an interesting one. Then we had the case of Innovative Bites Limited. So I think I mentioned earlier, the food ones are always the most fun ones. So although food is 0 rated, that excludes confectionery. Confectionery is subject to VAT at 20%. And confectionery includes any item of sweetened prepared food which is normally eaten with the fingers. And this case was the big giant marshmallows that you get for roasting on a bonfire, making s'mores. And actually the courts decided that's not confectionery. It's for baking, for cooking, so not confectionery. So now we're left with 5 potential different VAT treatments for marshmallows. So if you've got mini marshmallows, the kind you might put on the top of your hot chocolate or on the top of a cupcake, 0 rated if they're marketed for baking, 20% VAT if they're marketed for sitting and eating a bag of them. Normal sized medium marshmallows, 20% VAT. Giant marshmallows, 0 rated if they're marketed for roasting, 20% VAT if they're marketed for just sitting and eating a bag of them, which is just ridiculous, but that's where we are. And then the final case, so this only came out a couple of weeks ago, so I've only just added this slide. So biscuits, normally 0 rated, but there's 20% VAT if they are wholly or partly covered in chocolate. And this concerned these blissful biscuits, which you can see the picture of there. And if you look at the one on the right-hand side, you can see actually the taxpayer said it's not covered in chocolate, it's full of chocolate, and it has a biscuit on top of it. And the first thing that you bite into when you bite into it is the biscuit. Therefore, it's covered in biscuit. It's not covered in chocolate. But when you look at it, what an alternative, I can't remember if it's HMRC or if it was the judge, but they said, if it's partly covered in biscuit, what is the other part covered in? Surely it must be chocolate. Therefore, it's partly covered in chocolate. So the first tier tribunal have agreed with HMRC that biscuit is wholly or partly covered in chocolate, and therefore it's subject to VAT at 20%. I don't know yet if that one's going to be appealed. We'll have to see what happens. But yeah, the food ones are always the ones that are the most fun. And I think that was everything I wanted to say. So we'll see if there are any questions. I might do is to stop sharing my screen and then see. So I don't think we've got any in the chat box. Has anybody raised their hand? Do we know? Oh, we've got one person has raised their hand. Deborah, you're on mute.
Sorry, yes, we've had one person raise their hand. Angie, would you be able to unmute them?
Hi, I just wanted to ask on the penalty for the repayment. So you said that HMRC would pay a certain percentage back of interest if it's late. How does that work? Is it automatic? Do we have to apply?
It should be automatic. All the ones I've seen so far, it's been as when the repayment has been made, there's automatically been an interest supplement. All I would say is perhaps HMRC's systems aren't entirely foolproof. So if you think you are due one and there isn't one, maybe chase them up on it, but it should just happen.
Thank you.
Thank you, Hilary. Does anybody else have any questions at all? Well, Hilary, you've obviously explained it very, very clearly and everybody fully understands everything you've said.
Let's hope so. And like I said, everybody, if you do have any questions later on, you can always get in touch either to me direct or via Rycroft Glenton, and we'll be able to find an answer for you.
So if there are no further questions, I'd just like to thank Hilary and Michael very much for this very informative session. Who knew there were so many complexities to cakes, biscuits and marshmallows? I appreciate a lot of ground has been covered, but don't worry if you've missed anything or wish you'd made more notes as you were going along, because everyone's going to be sent a recording of the webinar after the event. And thank you all very much for attending. I do hope you found it useful. And as Hilary said, if you think of any questions afterwards or anything that you didn't want to ask during the session, please don't hesitate to get in touch with either Hilary or ourselves. So thank you very much indeed, everybody.
Thanks very much, everyone. Bye for now.
Thank you.
Thanks.